A safe and strong financial system is vital for economic growth, but maintaining financial stability is difficult. The 1997 and 1998 Asian financial crisis made this evident. South Korea, Indonesia, and Thailand were worst affected. Meanwhile, Hong Kong, Laos, Malaysia, and the Philippines were also affected by the collapse. Brunei, China, Singapore, Taiwan, and Vietnam did better than the rest of the region, but their demand and confidence dropped. Japan was affected but less severely. The question that needs to be answered is what exactly led to the financial crisis in Asia quickly and without warning at all? What kind of consequences have resulted from this situation? And what kind of lesson can we gain from this situation? Because of the financial crisis, many people have lost their whole life savings or have had their assets devalued due to fall in stock and real estate values. This problem is made worse when there is insufficient collateral for loans and when interest rates are excessive. The unofficial credit market, with its high interest rate, is the only option left for people as a result of this. In the immediate aftermath of the currency devaluation that caused the crisis, the price of goods and services that were heavily dependent on imported components rose dramatically. The cost of food is rising at a far faster rate than the cost of other goods in most countries. This is due to inflation, which not only decreased real income but also had a large negative impact on the value of real savings held by households when combined with the collapse of regional stock market. Because of the Asian financial crisis, central bank made monetary policy action that led to inflation. The root focus is on regulatory shortcomings and public-private banking and financial ties. Political forces to sustain strong economic growth led to a lengthy heritage of public guarantees to private undertakings, some of which were under government control, directly subsidies, or support by policies of direct loans to prefer MNCs. Before the financial crisis of 1997, 7 of the 30 largest companies had collapsed. Asia's investment rate and capital inflows remained high despite a series of profit warnings. It was a domino effect that led to a stock market decline, a drop in import receipts, and political upheaval in East Asia. As a result of the quickness and timing of the financial crisis, it is difficult to predict what may happen in the future.
The causes of the ASEAN financial crisis are numerous and difficult to identify. The collapse of the hot money bubble is seen as one of the main causes. Many Southeast ASEAN nations, notably Thailand, Singapore, Malaysia, Indonesia, and South Korea, saw huge economic expansion in the late 1980s and early 1990s with increase in their gross domestic product of 8% to 12% GDP. The ASEAN economic miracle was the name given to the accomplishment. However, the accomplishment came with a huge risk. As expansion in exports and foreign investment were the major drivers of economic growth in the listed countries. In order to draw in hot money, high inflation and fixed currency rates pegged to the dollar were set up. The currency rate was also set at a level that was effective for traders. However, because of the fixed currency rate regulation, both the capital market and corporations remain affected by foreign exchange risk. The Federal Reserve increased the mortgage rate to account for inflation in the middle of the 1990s as the United States recovered from a crisis. The US dollar increased in value as a result of the hot money flowing into the American market as a result of the higher interest rate. The growth of the currency connected to the dollar also impacted the expansion of exports. A shock to exports trades and investment called stock price, which were heavily leveraged by credit, to start falling. International investors started to pull out in a panic. The massive capital flight put downward pressure on Asian countries' assets. The Thai government was forced to let the baht float when it ran out of foreign cash to sustain its currency rate. As a result, the value of the baht fell straight away. Soon after, the majority of Asian countries experienced the same. The debates on the causes of the financial crisis future opposing and sometimes hated perspective from those who believe the crisis had domestic as well as foreign roots. The function of the modern state in East Asian growth has received a lot of attention in the wake of the economic crisis. Neoliberal supporters who perceive the crisis as being self-inflated were quick to attribute the catastrophe to crony capitalism, national governance structures, and interventionist state tactics. All IMF participation was based on removing the strong government business ties that had characterized East Asian growth and transforming Asian socialism with the neoliberalist belated belief to be politically natural, hence more powerful neoliberal culture. However, the early neoliberal Trumlius rhetoric also made space for a deeper analysis of neoliberal theory. The 1997 till 1998 financial crisis may have most important highlighted the risk of early financial liberalization in the lack of defined various regulations, the flaw of exchange rate regimes, the weakness in IMF suggestion, and the general lack of social welfare benefit in East Asia. Those who believe there are structural reasons were to blame for the catastrophe expressed this thought. Neoliberal opponents, on the other hand, concentrate on the economic and political institutions that affect the world economic sector. In contrast to neoliberal theories who concentrate on technical issue. The most extreme of these viewpoints was expressed by Mahathir, who claimed that the financial crisis was the result of a worldwide plot to undermine Asian economies. Nevertheless, his ideas were rather well liked in East Asia. The general belief that IMF recommendation tended to have more negative effect than positive one contribute in particular to the IMF and other global governance structures. The IMF has come under fire for its innovation and inflexible regulation, as well as its one-size-fits-all attitude, which mindlessly extends solution created for Latin America to East Asia. Economic welfare cuts have come under fire for being particularly unsuitable in the East Asian context and for escalating and extending both the political and economic crisis. The economics of the IMF and the overall lack of disclosure of its choices were also viewed in addition to the scientific benefit of IMF policy. The perception of East Asia at the IMF and World Bank relieved the impact economics, futility, and lack of alternative within the scope of present economic governance system. The combined critics of the IMF reduced its standing, if not its power, and increased call for an emerging global organization to control economic growth. The ASEAN financial crisis also showed the weakness of the United Nations, particularly the Association of Southeast Asian Nations (ASEAN) and the Asia Pacific Economic Cooperation (APEC), causing intense discussion over the future of both groups. The unstructured, non-legalistic institutionalism of both groups was particularly criticized. Although ASEAN has demonstrated a greater openness to institutional reform, informal intergovernmentalism still prevails in East ASEAN national agendas. Thank you.
Next, we move to the effect of financial crisis for countries. Massive speculative attacks on the Thai baht occurred on May 14 and 15, 1997. On June 30, 1997, Prime Minister of Thailand stated that the baht will not be devalued. However, Thailand lacked the foreign reserve to support the USD baht currency pitch, and the Thai government was eventually forced to float the baht on 2 July 1997, allowing the currency market to determine the value of the baht. This started a chain reaction of events that resulting in regional crises. Thailand's thriving economy came to a halt as a consequence of major layoffs in finance, real estate, and construction, resulting in large number of employees returning to their rural village and 600,000 foreign workers being deported back to their home countries. The baht rapidly depreciated, losing more than half of its worth. In January 1998, the baht fell to a low of 15 cents units to the dollar US. In January 1998, the baht fell to a low of 56 units to the US dollar. The Thai Stock Exchange dropped by 75%. Financial One, Thailand's largest finance firm at the time, went bankrupt. On August 20, 1997, the IMF authorized another 2.9 billion bailout package. As a result of the crisis, poverty and inequality increased, while employment, earning, and social welfare all decreased. Thailand's economy had recovered by 2001. The increased tax received enabled the government to balance its budget and repay its IMF obligation 4 years ahead of schedule in 2003. In October 2010, the Thai baht continued to rise, reaching 29 baht to the US dollar. Secondly, effect of financial crisis for Indonesia. When Thailand devalued the baht in July 1997, Indonesian monetary authorities increased the rupiah currency trading rate from 8% to 12%. As a result, the rupiah was suddenly under attack in August. The control floating exchange system was replaced on the 14th of the month with a free floating exchange rate arrangement. The rupiah dropped even further as a result of the change. The IMF offered a 23 billion rescue package, but the rupiah continued to fall due to concern about corporate debts, massive selling of rupiah, and strong demand for dollars. In September, both the rupiah and the Jakarta Stock Exchange reached an all-time low. Moody's eventually downgraded Indonesia's long-term debt to junk bond. Although the rupiah crisis began in July and August 1997, it became more reserved in November as the effect of the summer devaluation were visible on corporate balance sheets. Companies that had borrowed in dollars had to confront the additional costs imposed by the rupiah's depreciation, and many reacted by purchasing dollars by selling rupiah, further undermining the latter's value. Prior to the crisis, the rupiah to dollar exchange rate was at 2,600 rupiah to 1 US dollar. On 19 January 1998, the currency fell to more than 11,000 rupiah to 1 US dollar, with spot rate exceeding 14,000 during the 23 to 26 January period and trading over 14,000 for nearly 6 weeks throughout June to July 1998. On 31 December 1998, the rate was almost exactly 8,000 to 1 US dollar. Indonesia lost 30.5% of its GDP that year. As a result of the country's financial crisis, many factors, including sport broadcasting on Indonesian television, such as the ANTV, lost their television right to the broadcast the 1998 Formula One World Championship despite their Formula One broadcasting right contract in Indonesia lasting until 1999. As a result, the 1998 season was not aired on Indonesia television. Last but not least, effect of financial crisis for Malaysia. Speculator extensively traded the Malaysian ringgit in July 1997, only days after the Thai baht was devalued. The overnight rate increased from less than 80% to more than 40%. Rating downgrades followed, as did a widespread sell-off in the stock and currency market. By the end of 1997, ratings had fallen many notches from investment grade to junk. The KLSC had lost more than half its value, going from over 1,200 to under 600, and the ringgit had lost half its value, falling from above 2.5 to under 4.57 per dollar at 23 January 1998. The then Prime Minister Mahathir Mohamad enforced reserve capital restriction and fixed the Malaysian ringgit to the US dollar at 3.8. Malaysian actions, including fixing the local currency to the US dollar, prohibiting overseas trade in ringgit currency and other ringgit assets, providing offshore use the ringgit invalid, limited the amount of currency and investment that residents can take abroad, and imposing a minimum 1-year stay period for foreign portfolio funds, which has since been converted to the exit tax. The decision to invalidate ringgit outside has also dried up sources of ringgit held abroad from which speculators borrow to manipulate the ringgit, such as selling short. Those who did were forced to repurchase the limited ringgit at higher price, making it unattractive to them. It's also completely still trading in CLOB counter, freezing around 4.47 billion in shares and affecting 172,000 investors. The majority of those were Singaporeans, which caused a political problem between the two countries. The real economy's production fell in 1998, driving the country into its first recession in many years. Construction fell by 23.5%, manufacturing fell by 9%, and agriculture fell by 5.9%. In 1998, the country's gross domestic product fell by 6.2%. The ringgit went below 4.7 throughout the years, while the KLSE fell below 270 points. To overcome the situation, various defensive measures were announced in September of that year. In 2005, the last of the crisis measures were removed and taken off the fixed exchange system. But unlike the pre-crisis days, it did not appear to be a free float, but a managed float like the Singapore dollar.
Now I will talk about overall effect of Asian financial crisis. Real estate and stock market continued to be speculative in 1997, in part due to foreign investment, which resulted in large losses and total failure in the business and financial sector. The stock and real estate markets decline were to blame for this. There is a direct correlation between GDP declines and a rise in jobless rates. Firm closure and reduction in wages and working hours are all signs of a declining demand for labor. Secondly, during a panic among domestic and foreign investors in the summer of 1997, a significant reversal of financial capital inflows led to the collapse of regional currency. In the wake of this panic, regional currency were devalued. This may also reduce the amount of tax revenue the government collects, while a significant share of public funds will be required for the reorganization of financial institutions and the payment of the debt. The rapid rise in the cost of living, which is worsened by the bankruptcy of huge corporations and the layoff of employees, is a major problem for society. Because of the financial crisis, many people have lost their whole life savings or have had their assets devalued due to fall in stock and real estate values. This problem is made worse when there is insufficient collateral for loans and when interest rates are excessive. The unofficial credit market, with its high interest rate, is the only option left for people as a result of this. In the immediate aftermath of the currency devaluation that caused the crisis, the price of goods and services that were heavily dependent on imported components rose dramatically. The cost of food is rising at a far faster rate than the cost of other goods in most countries. This is due to inflation, which not only decreased real income but also had a large negative impact on the value of real savings held by households when combined with the collapse of regional stock market. Because of the Asian financial crisis, central bank made monetary policy action that led to inflation.
Now, I will tell you guys about the lesson from Asian financial crisis. Governments no doubt draw lessons from financial crisis and adopt measures to prevent their recurrence. However, these often address the causes of the last crisis but not the next one. More importantly, they can actually become the new sources of instability and crisis. This appears to be the case in Asia, where the lessons drawn from the 1997 crisis and the measures implemented thereupon may be inadequate and even counterproductive in crisis prevention today because they entail deeper global financial integration. An immediate step taken was to abandon currency pegs and move to flexible exchange rates in order to prevent one-way bets for speculators. However, under free capital mobility, no regime can guarantee stable rates, and crises can also occur under flexible rates. Floating at times of strong inflows can cause nominal appreciations and attract even more speculative inflows as seen in recent years. Second, equity markets have been opened on the grounds that equity liabilities are less risky and more stable than external debt. Consequently, non-resident holdings as a percent of market capitalization have reached unprecedented levels, ranging between 20 and 50 compared to 15% in the US. This has made them highly susceptible in instability in mature markets, particularly since most emerging markets lack a strong local investor base. Third, they have sought to address currency mismatches and exchange rate risk by opening domestic bond markets to foreigners and borrowing in their own currencies. Consequently, sovereign debt in many emerging economies is now internationalized to a greater extent than that is reserve currency countries, whereas about 1/3 of US treasuries are held by non-residents. This proportion is higher in many Asian economies. Unlike US treasuries, this debt is not in the hands of foreign central banks but in the portfolios of fickle investors. A consequence is significant loss of autonomy over domestic bond rates and exposure to interest rate shocks from the US. Fourth, corporations have been encouraged to become global players by borrowing and investing abroad, resulting in a massive accumulation of dollar debt since 2008, directly or through their foreign subsidiaries. Hence, the reduction in currency mismatches is largely limited to the sovereign, while corporations carry significant exchange rate risks. Asian economies are commended for improving their external balance and building self-insurance by accumulating large amounts of reserve. However, whether these would be sufficient to provide adequate protection against a reversal of capital flows is contagious. After the ASEAN crisis, external vulnerability came to be assessed in terms of adequacy of reserve to meet short-term external dollar debt. However, short-term debt is not always the most important source of drain of reserve. Currencies can come under stress if there is a significant foreign presence in domestic markets and the capital account is open for residents. A rapid exit could create significant turbulence, even though losses from declines in assets and currencies fall on foreign investor and mitigate the drain of reserve. Should self-insurance prove inadequate, there are two options: seek assistance from the IMF or engineer an unorthodox response, banning in international creditors and investors by introducing inter alia exchange restrictions and temporary debt standstills, and using selective controls in trade and finance to safeguard jobs. ASEAN countries, like many others, are determined not to go to the IMF again, but serious obstacles may be encountered in implementing unilateral heterodox measures, including creditor litigation and cession by advanced economies, deepening integration into the inherently unstable international financial system before attaining economic and financial maturity, and without securing multilateral mechanism for orderly and equitable resolution of external liquidity and debt crisis could thus prove to be highly costly.
The last part is conclusion. To recap, the Asian financial crisis that shocked the world 20 years ago was a watershed moment for many of the region's economies. The crisis uncovered structural flaws and policy distortions in crisis-affected countries, as well as poorly planned financial liberalization and premature capital account opening. The crisis had significant macroeconomic effects, including sharp declines in the value of several Asian countries' currency, stock market, and other asset prices. Many businesses failed, and as a result, millions of people fell into poverty in 1997 till 1998. The countries most affected by the crisis were Indonesia, South Korea, and Thailand. In the absence of political will to raise taxes or cut spending, government must rely on scissors to fund bank bailout. A currency crisis is unavoidable in a world of forward-thinking agents. According to the model developed by Burnside, Eichenbaum, and Rebello, the collapse of a fixed exchange rate occurs once agents learn that upcoming deficit will rise, but before the government enforces its new monetary policy. In this scenario, it will be impossible to predict currency crisis using common macroeconomic aggregate like past and present inflation and fiscal deficit. In this limited sense, the model justifies claim that Asian crises were difficult to forecast. More importantly, the findings suggest that econometric analysis aimed at forecasting currency crisis should look beyond government's past fiscal and monetary policies. Information that can be used to predict future fiscal deficit should receive at least as much consideration. On a final note, despite the comprehensiveness of the Asian financial crisis, as well as the limited success achieved thus far in countering it, successful resolution of the crisis does not necessarily require either a new game plan or a new IMF. The overall design of official rescue packages has been much more correct than incorrect, and there is still time to improve market discipline and burden sharing aspect. A sustained upward turn will occur when crisis countries have made sufficient progress in implementing structural reforms to persuade markets that things have truly changed, and when there has been sufficient rescheduling of private debt To reduce uncertainty and moral hazard in the future, Asia must pursue broad-based reform to address new and existing security flaws and ensure financial stability.